All right, hey folks. I know I sent out a banner and then also a very a push notification, but I know we haven't had this discussion in a while, and I wanted to because it's important that we learn how to not only manage our winners but learn how to manage our risk and how we do that. Now we've talked in the past about how putting actual stop orders out there in an option market can be dangerous, and you can get slipped for quite a bit. And so what I do is I set myself alerts on where the underlying should be theoretically when I hit whatever price target that I want to. And so I wanted to use this example in Apple of the signal that we just got in on how we would manage that. So this will be a relatively short video, but at any rate. So when we got in, we were a little bit higher. We were let's just say we won 172.50 was about where we are. We're a little bit lower than that right now. So you put in, and this is part of the options trading tool, and it's I believe the third tab over. It's called the spread delta calculator, and it's there's some stuff up here, but this is towards the bottom of the spreadsheet. So remember, in all of my my spreadsheets, at least computational spreadsheets, you can type in yellow areas, don't type in white ones. If you type in the white ones, you're most likely going to take out a formula or a reference cell, and then you're going to mess up the whole thing. Okay, so we can do this for a call or we can do this for a spread. It doesn't really matter. We can do this, and then if we do a call spread or a call here, put spread or put here. So like I said, we want to put in the where we got in, and then what the spread price was, and we got in for 55 cents. We can get the delta of that spread, which is 26 minus 17, so it's about a 9 delta. It's a debit call spread, so that's a positive number. So that's a 9 delta. Now you just have to decide, okay, what do I want my profit target to be, and what do I want my stop target to be? Because we can't just concentrate on profits. We have to manage our risk if it doesn't work out for us. Okay, so the profit target, and this is, it's not arbitrary, but it's subjective. So for a swing trade, what I'm ideally looking for is a profit target of a 70% winner, and then willing to lose 50% if everything works out right. Okay, so using that, we can say, okay, if I want 70%, that means that I need to make 39 cents on my 55-cent investment. Let me bring in a calculator here and do that for you. So we get in at 55, and if I want a 70% winner, 55 cents times 0.7, it's about 30. It's 38.5 cents, but it's going to round it to 39 cents. And as a loser, 55 cents times half, that means that I'm going to risk 27.5 cents. So now we have to ask ourselves, okay, if I want a profit of 39 cents or willing to take a loss of 28 cents, how far does that delta need? How far of a move do we need to get there? And what that is simply is it's going to be, so let's look at the target profit price. That's going to be 39 divided by 9, which is, because we know for every dollar that we move in Apple, this is going to increase in value by 9 cents. So 39 divided by 9, we can see here, 39 divided by 9 is $4.28. Conversely, on the way down, we take 28 divided by 09, and we get here's the needed delta move up. Delta move down is this, which is $3.06. So we take where we got into the spread, 172.5, plus the 428, we get that is where the theoretical price should be when we get to our target exit for profit. And if we get down to 169.44, that's going to tell us that we're going to need to get out. Now, realizing that these are approximations, because I'm not taking into consideration things like theta and gamma. It's a straight line. It's an approximation. That's why you have to continue to look at it, but it's better than nothing. And so what you can do is then you just go out and you put an alert out there to say, okay, if Apple gets, above 176.5, I want to have an alert, and if we get down below 170, I want to know about it. And then you can deal with it from that standpoint. Okay, so that's in the spreadsheet. You can download that from the Documents tab. Any questions on that? How do I get the needed delta moves? That's what the delta move. The needed delta move is going to be the amount of money that you need. So in this case, a 39-cent profit. 39 divided by 0.09 is $4.28. Conversely, I'm willing to risk 28 cents. 28 cents divided by 0.09 is $3.06. So then you just take the 428 plus this. That's 176.78, or the 172.50 minus the $3.06. That's where you get that. Any questions on that? Okay, good. Like I said, this is a relatively short video, but as we continue to get, what about the delta of the GHE spread? I don't understand, Eloise. The question was, what about the delta of the GHE spread, the 99? The spread delta. I don't understand. How did I get what the delta of the spread is? The delta of the spread is right here. It's a 26 delta on the 77.5 calls. It's a 17 delta on the 180 calls. 26 minus 17 is 9. Or you can get it from, it'll show, like here, it'll show you, here it's a 9 delta. If you're using Thinkorswim, it'll tell you what the delta is. Or you can just go out there and look at the deltas manually and subtract them. Okay, good questions though. Thank you. Okay, so that's it for this one. Any other questions or any other topics you guys want to talk about, throw them out there. It's Friday afternoon, not a lot of trade going on, but that doesn't mean we can't learn. All right, thanks a lot. I'll render this video and get it out to you guys ASAP.